Hi, good afternoon or good evening, everyone. We are just waiting for 1 more minute to join in the more participants, and we'll start. And sorry for the little delay due to some technical reasons. So, Bilal, you can share your screen. Okay, yeah, I can see. Okay, I think we should start now. Again, thank you so much, everyone, for joining. As IF is always committed to have some webinars for the continuous development of the members of the institute as well as the non-members. So with regards to that, today we have the topic with us, IFRS 16 leases. Mr. Bilal is the presenter or the guest speaker with us, and he is going to speak about the IFRS 16 leases mainly. He will give you the overview. He will also touch some areas in detail so that you can have some upgradation with regards to your knowledge. With regards to Mr. Bilal, he is a qualified chartered accountant from Institute of Chartered Accountants of Pakistan. He's having more than 10 years of experience in the field of accounting and finance. Currently, he's working with the leading audit firm in Saudi Arabia. It's PKF Al Bassam. Previously, he was also associated with some tier 1 firms, as well as with some industry backgrounds as well. So over to you, Bilal.
Okay, thank you, Salman.
Bilal is audible to all of you clearly? Okay, yeah. Okay, yep.
Yeah. So I guess Salman has already explained about my background, so I would not take your people time about my introduction. So in today's webinar, we would be covering the IFRS 16. On the face of it, it is very, it looks very simple standard, but when we go into the detail, it hides in itself a very great deal of complications. So in today's webinar, we would be covering the basic fundamentals of IFRS 16. My primarily focus would be on the accounting treatment of lease from the lessee's point of view, because in the recent changes in the IFRS 16, this was the major area which was changed by the standards. Previously, leases were dealt under IAS 17, but now they changed the standard and they eliminated the IAS 17, and now all the leases concepts are covered within the purview of IFRS 16. So in today's session, we will be talking about key concepts, and I would then explain the key concepts, and then we would be looking at the accounting treatment from the lessee's point of view and some of the complication we normally face practically when we do the accounting as a lessee. Then we would be looking at the accounting treatment from the lessor point of view. And I would explain the complication faced by the lessor itself. And then at the end, I would also tell you the topics we have not covered into this session because of the time limitation and the complexities involved. And hopefully we will be having another session to cover those topics as well. So without further ado, let's talk about first of all, when we talk about the lease, first thing we need to do is to assess whether the contract itself is a lease or no. For this, standard has prescribed 4 major things. When you talk about the contract, we need to assess whether there is involvement of any right to use the asset. Now, when we say the right to use, it involves the control to use this asset. What does control mean? We will discuss later. And then we need to assess whether that contract covers the specific period for which we can use the asset. And then, of course, there has to be some kind of consideration involved. The IFRS 16 bifurcates the leases into two types of leases. And the first one is finance lease, and the second one is operating lease. In the previous standard, both lessee and the lessor has to bifurcate and assess whether the lease under consideration is finance lease or operating lease. But in the new standard, the standard does not give lessee any right to bifurcate the leases. For the lessee, the contract treatment is pretty straightforward, but the lessor still has to do the bifurcation between these two types of leases. So for the finance lease, when we say the finance lease, that when the lessor substantially transfer all the risk and rewards associated with the lease to the lessee. Now we will discuss this in detail when we go to the lessor accounting treatment. And if any lease is not finance lease, it is operating lease. The next thing we need to be very careful about is the inception, the date of the lease. There are two dates which are defined by the standard. The first one is the inception date of the lease, and the second one is the commencement date of the lease. There's a very fine line difference between these two. The inception date represents the date on which both parties agree or enter into agreement for the lease. But the commencement date is when the asset is actually made available to the lessee for its use. How I can explain it further is, for example, if you rent a shop or rent a showroom from any builder, what they usually do is they give you, you enter into lease 5 months earlier, 6 months earlier, but they do some renovation, then they give you that handover will start after 6 months when you enter into agreement. So we need to be very careful about the commencement date of the lease, because that's the date when the accounting treatment will start. So commencement date is when the asset is actually made available to the lessee for its use. When inception date is when just both parties just enter into the agreement. The next thing is lease term. Whenever we talk about the contract, first thing we need, whether we are doing accounting for the lessee or the lessor, first thing we need to identify is the term of the lease. The lease term defined by the standard is non-cancelable period. If the period is cancelable, then it would not be part of the lease term itself. Now standard says that non-cancelable period for which the lessee has the right to use an underlying asset together with both. One thing, option to extend, if the lessee is reasonably certain to exercise that option. For example, the lease contract may say that the lease has a non-cancelable period of 5 years. However, the lessee may have the option to extend for another 3 years. So if you are doing accounting from the lessee's point of view, you need to be very careful whether the lessee intends to exercise that optional period or no. If it intends to exercise that optional period, the lease term would be the original period non-cancelable, which is 5 years, plus the optional period. The second is the period covered by the option to terminate. For example, the lease clause may be the lease term is for 5 years. However, after 3 years, lessee may terminate the lease. So in this case, if you think the lessee intends to terminate the lease after 3 years, your lease term would be for 3 years only. But the important thing to consider in these two scenarios is the standard gives the right to the lessee only. If the term is cancelable or it can be terminated by the will of the lessor, it would not be considered as part of the lease term. So we need to be very careful that these both options are given to the lessee, not the lessor. The next thing is economic life. I hope most of you are familiar with the economic and useful life, but for the IFRS 16 perspective, we need to be very careful about these two, because when we, when we try to distinguish what type of lease is, whether it is operating lease or finance lease, useful life will play a major role. Economic life is the total life of an asset under consideration. Now the useful life is the total life and for which the asset would be under you by the party itself. For example, I purchase an asset, I lease an asset for 5 years. The useful life for me would be just 5 years, whereas the economic life may be more than 5 years. It may be 10 years or 20 years or more. So we need to be very careful about these two. Next thing is the lease payment. Now, lease payment includes the first of all, obviously, would the lease rental, which we all understand. The lease rental, whichever the lessee would pay, would be the part of lease payments. The next thing is variable lease payment. Now, this is a very tricky part, which was introduced by the IFRS 16. It was not covered by the IS 17 in the previous standards. So we will talk more about this, the variable lease payment element. The next thing is the exercise price of the purchase option. Like we discussed, if the lessee is reasonably certain to exercise the extension option, and then we need to consider that price which he will be required to pay to exercise that option, that price would be made part of the lease payment. And what impact this would have, we will discuss a little bit later. Now, the next thing is amount expected to be paid by the lessee under the residual value guaranteed. For example, lessee may lease an asset for 5 years, and 5 years was the only life of the asset, and lessee may agree that at the end of the 5 years, I will pay 100,000 to the lessor or 200,000, whatever the amount is. The thing is, if the lessee has guaranteed any amount as a residual value to the lessor, that has to be considered as a part of lease payments. The next thing is the payment for penalties for terminating the lease. If the lessee, we can reasonably say that a lessee will not complete the lease term, or he will opt the option to terminate the lease. So all these payments would have to be made part of the lease payments when we will be doing our calculation. Now, just like I said, the first step whenever we look at the lease contract is to identify whether that contract should be classified under IFRS 16 or some other standard. So in order to categorize as a lease, any lease contract under lease contract, we need to look for 4 things. First thing is whether there is a right to control the asset or use the asset involved. When we lease the building is the asset, and that asset has to be identified. The second thing is whether there is a defined period of time, 5 years, 2 years, 3 years. The last thing is there should be a consideration in exchange, which we normally say is the rental value. Now, there's one scenario, for example, I have a related party. I can give related party my offices for use and free of cost. I may not be able to charge them anything. And I say, you can use this for 5 years. You don't have to pay me any rent. Now, the thing is, does this kind of transaction be part of IFRS 16? No, it will not, because it does not involve exchange of any consideration. It would be covered under other standards. When we say that whether the contract conveys the right to control the asset, the control itself, if you attended the last consolidation seminar, the control here means that whether all the economic benefits would flow to the lessee, and whether the lessee can direct the use of the assets as per his will. So these 2 elements has to be present to conclude whether the control of the asset exists or not. The next thing is, which we need to be very careful, is the component of the contract. The one thing which we, very common in the real estate industry, for example, if you rent out any shop in any good plaza, the part of the contract may bifurcate the price between the lease components and the non-lease component. What do we mean by the non-lease component is, for example, the contract may say the rent of the shop would be 100,000 a month. Now, they may say that this 100,000 includes the element for provision of the amenities, because when we rent out a shop in any plaza or any district, the builder may provide you some sort of amenities, cleaning, security, advertisement, that kind of services. So standards say primarily lessee should bifurcate the lease component and non-lease component. For example, the contract says that 80,000 will be for the shop of the rent and 20,000 will be for the provision of the amenities. then the rental for the assessment of the lease should be 180,000 only, and 20,000 which we are paying for the provision of amenities should be treated as non-lease component and should be expensed out on the straight line basis. However, standard also gives the option to the lessee that if the lessee chooses, he may not separate this non-lease component and account for is as a part of the lease and do his calculation with a single rental of 100,000. Why standard does this? Because the provision of amenities and all the non-lease component would not exist, and they only exist with the lease itself. If the lease does not exist, those services also not exist. So standard gives the option to the lessee to either separate that non-lease component or do not separate the non-lease component. So, but primarily, lessee should separate all the non-lease component from the lease component and only do the accounting for the lease part. Because the next thing is the accounting treatment for the lessee itself. Now, the IFRS 16 says whenever you're doing the accounting for the lessee, at the commencement date of the lease term, standard does not say the inception date. Standard says the commencement date, which is the date at which the asset is made available for use to the lessee. So the date on which asset is made available to the use, what lessee would do, lessee has to recognize the right of use asset against the liabilities against the finance, against the lease. In the previous standard, what we used to do, we also recognize an asset and book the lease liability, but we used to recognize that asset as part of property, plant, and equipment. In this standard, the IFRS 16 has described a specific term, which is right of use asset. The standard says that at the commencement of the lease term, you have to recognize the right of use asset against the lease liability. How we will calculate it, we will discuss later. Now, the cost of right of use asset will normally include, the first thing is very obvious. When we book the lease liability, it would be right of use asset debit and lease liability credit. So this amount would be the part of right of use as cost of right of use asset. But standard also say that you have to include other elements as part of right of use asset as well. What are those other elements? For example, one other element may be any initial direct cost incurred by the lessee, which is very obvious. One more thing is any lease rental already paid by the lessee before the commencement date. Now, this is a tricky part. If you are working in the kingdom, you will see that 2 years ago, all the companies which were preparing their financial under IFRS 16, they adopt under IFRS they adopted the IFRS 16. Now, at the date of adoption, they already had some sort of rental paid, which they recorded as a part of prepayment, because previously they were amortizing that rental over the on accrual basis. So they may have some sort of prepaid portion of the rental, which would be appearing in their asset side. The standard says that whatever the rental you have already paid at the commencement date, eliminate that portion from your prepayments or other balance sheet head and include it as a part of your right of use asset. The last thing which standard says should include is the liability against any dismantling or decommissioning. Now, this part is covered by the IFRS 1 itself. For example, if you lease the land from the government and you construct your plant on that land, and the clause may say that at the end of the lease term, you may have to return the land in its original shape. So obviously, you will need to incur some dismantling process, and you will need to incur some significant amount of expenses to dismantle your plant and bring the land into its original shape. So IFRS 1 says that you have to book the liability against the asset, and that amount of that cost against that liability should be made part of the right of use asset. Now, let's talk about the initial measurement. When we said that at the commencement of the lease, the lessee would debit the right of use asset and credit the lease liability. what the lessee would do, lessee has to calculate the present value of all the lease payments which he is expected to pay. We already discussed what would be the lease payments. Lease payments would be the rental he will be paying in the future. It would also include the penalties. It will also include the exercise price to opt for the extension, and all basically whatever the rent cash flows will be incurred by the lessee has to be made part of the lease payments, and we will discount those lease payments, and whatever the amount is, we will book the lease liability against that amount and book the corresponding relative use asset. Now the question is, when we discount those lease payments, what should be the discount rate to be used for discounting? The standard says primarily you should be using the implicit rate of interest in the lease. What is this? We will discuss when we will, we will be discussing the accounting treatment for the lessor. But practically, this implicit rate of interest is not readily available for the lessee. So standard gives you the option, if the implicit rate of interest is not available, the lessee can use the lessee's incremental borrowing rate. So practically, normally what companies do, they use the incremental borrowing rate for the treatment of the leases. Okay. So I can have one question. Pierre, I would be explaining. I would be covering your question once I'm done with this basic accounting treatment. Now, the lease. When we talk about the lease payments, we already covered this element. So let's take a basic example like this. A very basic scenario. The annual rental for the lease is 1 million. The lease term is 5. Can you guys see the Excel sheet which I shared?
Yes, Bilal, yes, we can. If you just
Okay.
zoom in more.
Okay, I will. It's better now?
Yeah.
Okay, so let's take a very basic scenario. The annual rental is like 1 million. The lease term is for 5 years. The implicit rate, we can assume that we don't have any implicit rate in the lease. So we would be using the incremental borrowing rate. We can estimate that this is 5% in this scenario. What we need to do is that in the first step, we will need to record the right of use asset against the lease liability. Now, what are the lease payments in this case? The only thing we are paying is the annual rental of 1 million. So what we will do, 1 million for each year, and total rental is 5 million. We will calculate the present value for each year, and the total would give us 432,9477. Or we can also do this. The shortcut is this formula: net present value. The rate is this 5%, and then the rental we have is this. Result would be the same. So at the initial recognition, the entry would be right of use asset debit and the lease liability credit. Now, once you're done with this, in every year, that lease liability portion would be unwinded with the amortization table, and this would be depreciated over the lease term. So in this case, 5 years. So every year, this 4.3 million would be depreciated with an equal amount. So let's talk about the subsequent measurement of the lease liability. We have recorded the lease liability in every year. What was the discount rate we used? 5 million. So this would be the opening balance for the year 1. So I will simply delete this. Every year I have to book the finance cost on the lease, which is equal to the outstanding balance multiplied by the interest rate. And my annual rental is 1 million. So I will just here, and you will see that at the end of the lease term, my lease liability is 0. What is happening basically? Total amount I'm paying is 5 million, but the standard says that the cash difference between the cash value and the nominal value would be charged to the profit and loss, which we in the layman term say that is the what we can say is the difference between cash with nominal value, time value of money concept. Standard simply says that apply the time value of money concept on the rental, and whatever the difference is, that has to be charged into the profit and loss. So in the year one, when we say that how this would be unwinded, first of all, when I calculated the finance cost, it would be finance cost will go to the profit and loss, and it would be added as a part of lease liability. When I pay the rental, what will happen is lease liability debit and cash and bank credit by 1 million, and this by this. The same thing will continue every year. Every year, what we will do, we will take the opening balance, multiply that balance with the interest rate, which we use to discount the cash flows, and then reduce the liability with the rental which we will pay in that year. So every year, so doing this, at the end of the lease term, the lease liability would be 0. Coming back to the right of use asset, initial recognition, the right of use asset had a cost of 4.3 million. So every year we would be depreciating on the lease term. So for 4.3 million divided by 5, it was simple, pretty straightforward calculation. So every year 800,000 would be going to the profit and loss as a cost of depreciation. So if I summarize all the entries which we will be posting over the course of 5 years, it would be like this. At the year 0, at the inception of the date, initial recognition, we would be booking the right of use asset against the lease liability. In the year 1, we would be booking the depreciation expense on the right of use asset. We will be booking the finance cost on the lease liability, and we will be paying the rental under the lease agreement. And same practice will continue for the 5 years. And by the end of 5 years, there would be no lease liability and there would be no right of use asset. Okay. So this is a very basic example for computation of the lease liability in a very straightforward scenario. Now, when we were discussing the lease payments, we said that lease payments should include the fixed payment. In this scenario, we discussed 1 million, but it should also, we discussed that it should also include the variable lease payment. Now, when we say the variable lease payments, it's a very tricky part. When we say variable, we can categorize these variable lease payments into 2 parts. The first thing is the lessor may say that whatever the rental lessee will pay, it would be linked with the consumer index or the cyber rate or whatever the country we're dealing is, whatever the floating rate in that market is. The rental may be linked with that floating rate of interest, and so that will give us a variable lease payment at the end of every year. So standard says in this kind of scenario, what lessee needs to do is at the initial recognition, compute the all lease liability using the rate which was prevailing at the date of commencement and recognize your right of use asset and lease liability against that rate. Now, subsequently, at the end of every year, recompute the rate based on the revised consumer price index or whatever the variable the rate was linked with. Use that revised measure and revise your rental, and whatever the difference comes to your calculation, record the difference in the lease liability against right of use asset. So in the subsequent years, when we will remeasure the lease liability, what we will be doing, if the lease liability is increased, we will debit the right of use asset by that amount and increase the lease liability and continue this cycle every year. Now, the second type of variable payment may be, for example, I took building from someone and I say that if my sales are this amount, sales amount 1 million, I will pay you 25% of my sales amount as a rental. I may pay you 50% of my profits as rental. These type of transaction or these type of rentals are not covered by the IFRS 16. And if this is the case, we cannot use estimates in the calculation of the lease, and we will have to simply charge this kind of variable into the profit and loss as and when they incur. So only type of variable lease payment defined by the standard is those variable which are linked with the consumer price index or some other like KIBOR or LIBOR, whatever the interbank exchange rate is. So those kind of variable are covered within the IFRS 16, and these kind of contingent payments on the future sale or profits are not covered within the IFRS 16. In the second scenario, we will simply, whatever the amount we will pay, we charge it as expense. The reason is because in the second scenario, it is practically not possible to build a reliable estimate. We cannot say how much the sale would be in the next year or a year after the next year. The next complication we face in accounting of the leases is a remeasurement of the lease liability. What do we mean by the remeasurement is that, for example, you took a shop on the rental for 5 years. At the year second, third, or fourth, your rental may increase. For example, the COVID scenario, or just like now, some countries are facing very huge inflation. Cost of rental is going very high. So if some change happens within the lease term, which was not part of the original agreement, so standard says that in this scenario, you have to remeasure your lease liability, because when we calculated the lease liability, how we did it? We simply calculated the present value of all the future rentals, and then we use the amortization table to unwind that lease liability. If the rental in any of the year is changed, for example, if I change this to 1,200,000, my lease liability would not be eliminating by the end of the lease term. So standard says if this is a scenario, you have to remeasure your lease liability whenever there is a change. Now the question is, when I remeasure the lease liability, what is the discount rate I should be using? Standard says that if there is a change in the guaranteed residual value, then you can use the revised lease rental with the original discount rate, in this case, which is 5%, or the change in the lease rental is due to the market conditions, or rent increased, or there was inflation, or the rental was increased to match the rental with the market prevailing rate. So in these kind of scenarios, we will use the lease rentals, revised lease rental, and discount them using the original interest rate which we used at the time of initial recognition. The second thing is, standard says that if these two are not the scenario may be different. For example, the non-cancelable period may change from 3 to 5 years. Okay. Or the lessee, in the scenario one, lessee may have opted not to extend the lease period, but now after 2 years, lessee may say that no, I will exercise for the full term. Or the lessee may say that previously lessee estimated that it will not terminate the lease, but now the lessee estimate that it would be terminating the lease. So in these cases, in this new scenario, standard says that now you have to discount the revised lease payments using the revised discount rate. What is the revised discount rate? At the date of remeasurement, you will reassess whether the implicit rate of interest is available. If not, then you have to use the lessee's incremental borrowing rate at the date of remeasurement. Let's take a look at the very basic example for the remeasurement of lease liability. We will continue the same example. We booked the initial liability of 4.3 million, but at the end of second year, rental for the third, fourth, and fifth year increased from 1 million to 1.2 million. Now, this is the original amortization table which we built using the previous example, what we see that at the end of 2 years, the lease liability was 2.7 million. Now, before I explain any further, I need to explain one thing. The beauty of amortization table is that at the end of every year, the outstanding liability represents the present value of the remaining lease payments. For example, if I take the present value of remaining lease payment at the end of year 1, it would be you see, it's matching. And if I continue the same thing for the next years, it would give me the same result. So that is the way how amortization table works. At the end of every year, the outstanding liability should represent the present value of outstanding rentals, which the lessee would be paying in the coming years. So in the remeasurement, what we will do, whatever the liability at the time of remeasurement is should represent the present value of the remaining lease rental, which would be paid in the future. So the revised rental are 1.2 million in the year 3, 4, and 5. So what we will do, we will take the present value of the revised rental using the original rate of interest. It gave us, it gave us 3.2 million. Now, at the end of year 2, what is outstanding liability? It is 2.7 million. So difference is 544,000. Now, standard says that this difference has to be adjusted against the right of use asset. So what we will do, we will debit the right of use asset and credit the lease liability. So after incorporating this change, our lease schedule would look something like this. We added the the remeasurement fact, and now my liability is 3.2 million. So I will unwind the 3.2 million over the next 3 years, and the same calculation I will just take the opening balance, multiply with the discount rate, and it would give me the finance cost for the year, and the rental would change from 1 million to 1.2 million. And you will see that at the end of the lease term, the lease liability is becoming 0, as it should be. In the right of use asset, the original one, just with the minor change, is that this was added to the cost of the asset, 544,000, and in addition to the original depreciation, this would be depreciated over the next 3 years. The depreciation would be revised from 865,000 to 1 million. So at the end of the lease term, both right of use asset and lease liability are becoming 0. If anyone has any question till this point. You see, PR, you asked.
Bilal, we have so far 2 questions. I'm also looking in the chat box. One is with regards to related party. I think you will reply later.
Yeah. And the I'm just explaining right now. What is the other question?
The other one is from PR Ali. He's saying, can we recognize IFRS 16 transactions such as ROU and finance costs on related party? Okay, I think this is you already have. The other one is, what is the treatment if we exit the lease before end of contract?
You see, about the second question, you see the term we use is non-cancelable. The non-cancelable has to be non-cancelable by the both parties. Now, if the lessee has the option to terminate, there may be some kind of penalties. Now, when we initially recognize, we have to incorporate all these factors before making our initial recognition. If we say that lessee would, non-cancelable period was 3 years and 5 years, and lessee has the option to terminate at the end of the 3 years, and at the initial recognition, we are certain that, and the lessee would not terminate, then lease term would be 5 years. But if subsequently we came to find that lessee would not be continuing with the lease, then straightforward, whatever the penalties, for example, The non-cancelable, just a scenario, the non-cancelable period was, the lease term was 5 years and lessee had the option of terminating at the end of 3 years. Initially, you estimated that lessee will continue for the 5 years, but at the end of the year 2, lessee thought that this is a loss-making project. So by the end of 3 years, I would be terminating the lease. So just I discussed, now at the end of the 2 years, lessee would have to remeasure the lease liability, right? Remeasure the lease liability because it would, using the revised rental and discounting them at the revised discount rate. This is the one scenario. Other scenario is there was no termination clause and just sort of sudden lessee went bankrupt and lessee decided to just, vacate the properties and discontinue the lease. And in this scenario, whatever the penalties you have to pay, you will simply de-recognize all the lease liability and all the underlying right of use asset. And whatever the difference is, you will charge it to the profit and loss. For example, coming back to the original scenario, in this scenario, for example, let's just assume that there was no termination clause or anything of that sort. And the lessee, at the end of the year 3, lessee decided to, terminate the lease altogether. So what we will do, we will credit the right of use asset. The right of use asset had a value of 1.7 million by the end of 3 years. And we will debit the lease liability. And lease liability was standing at 1.8 million. We have a difference of 127,000, and this difference would be charged in the profit and loss in the credit side, like this. But it is a very rare scenario, because when you are entering into the contract for the long-term contracts, the cost of terminating these contracts is very huge as compared to continuing the lease itself. So I hope I have covered your answer. The next question is for the PRLE. Now the thing is, whatever the transaction you enter into with your related party, it can be lease transaction. So it has nothing to do, it will not require any special treatment. Whatever the transaction is, it would be counted for under the IFRS 16. Just a minor change that you have to disclose those transactions as per the requirement of IS 24 in the related party note itself. So whether you are entering into transaction with the related party or some other party, it will not impact your calculation as per IFRS 16. If it is related party, you have to disclose this as related party transaction in your financial statements, right? So any other question? So I will continue. Now let's talk about lease modifications. What is meant by the lease modification? You rented out one shop in any building. After 3 years, you decided to acquire another shop under the same lease agreement. Now, standard says that if there is some kind of lease modification representing this type of stuff, and as a result of this modification, it increases the scope of the lease and it gives you additional right of use to additional assets, and the consideration of the lease increases by the amount, comparable amount. Standard says, and in this scenario, this modification should be treated as a separate lease and the original lease should not be changed, right? If this is not the case, anyone has any question on lease modification? Okay. So if this is not the case, so in this scenario, just 1 second. I think I have. Sorry. So if the modification result in increasing in scope and it gives the lessee additional asset for which it has a right of use, it should be treated as a separate lease itself, and the original lease would not be changed. And how we account for the separate lease is the same principle which we applied in the first place. What we will do, we will discount the cash flow of the revised additional component of the lease and discount them using the revised discount rate, whatever the rate was prevailing at the date of modification. For example, the initial discount rate may be different from the current one. So we have to make sure that for the lease modification, we are using the revised discount rate for the revised additional rentals. The recognition principle and method for calculation would remain the same, whether it's an additional component or not. Next thing is standard says, standard prescribe the method for recording the leases for the lessee, but we cannot apply these method for all the leases, because standard says that this rule, these two categories would be exempted from this rule. The first one is short-term leases. If the lease is for less than 1 year, standard says that simply expense that out in the profit and loss when the expense is incurred on accrual basis or any other state and method which the management may prefer. But you're not required to discount the short-term leases and prepare the amortization table. The second one is the low value leases. What does standard mean by the low value leases? The value itself may vary from company to company. One value may be lower from my perspective, and the same may be material from another perspective. The standard did prescribe the threshold. In fact, it suggested the threshold at the value of USD 5,000. The standard says if any as a result of any lease, underlying right of use asset becomes equal or greater than 5,000 USD, then it needs to be booked as a right of use asset. Otherwise, you can simply expense out as part of low value leases. But what we need to make sure is that disclose these both amounts into the financial statements, that the lessee has expensed through these two expenses amounting to this amount in the financial statements. So these two are the exemption to the basic rule of accounting for the lessee. Coming to the accounting treatment for the lessor itself, before we proceed, we need to understand few key concepts which are carried forwarded from the IS 17. The first one is the major one. It is the interest rate implicit in the lease. When I said that lessee has to discount using the implicit rate of interest, the implicit rate of interest is usually for the lessor. It is calculated from the lessor's point of view. Now, what is this implicit rate of interest? Standard says that it is the interest rate that causes the present value of the lease payments. Now, what are the lease payments? We already discussed. Present value of the lease payment and unguaranteed residual value to be equal to the fair value and any initial direct cost of the lessor. In other words, it should be that rate that if I discount all the lease payments and unguaranteed residual value, the present value of those payments should be equal to the fair value of that assets. So whatever the rate make these two things equal, it is that implicit rate of interest. How we're going to calculate it, I will explain later. The next thing is unguaranteed residual value. Now, by name itself, it is very clear that it is a residual value of the underlying asset, but it is not guaranteed by anyone. For example, I'll just give you one example. For example, you leased a building for 10 years, and out of that building, there was one shop which you subleased to another tenant for 5 years. Now, at the end of the 5 years, can we say that that asset did not have any value? Definitely it had any value. Then what is that value? That is your unguaranteed residual value. How we calculate it? It is altogether another technique. It involves valuation and that kind of stuff. The next thing is gross investment in the finance lease. The gross investment is the lease payments plus the unguaranteed residual value. The net investment in finance lease is present value of gross investment in finance lease discounted at the implicit rate. Now, let's talk about the implicit rate of interest. What we said, that it is a rate which makes, which causes the present value of the lease payment and unguaranteed residual value equal to the fair value of the underlying asset. Now, it's a very basic scenario. The lease term is 7 years. Annual rental is 10,000. Unguaranteed residual value was 2.5 million. In this case, we can say that fair value and underlying asset had the carrying value of the asset was 50,000. So, what we discussed is that what is the implicit rate? The technique used for calculating the implicit rate is the IRR formula. So at the one side, we will take the present value, the fair value, which is 50,000, and the annual cash flows, which is 10,000 per year, and the unguaranteed residual value. The total is this. If we take the IRR of this, it would be 10%. Now, we said that implicit rate is rate which makes equal the present value of all the lease rental equal to the fair value. So these things are my lease rental, lease payments, right? Unguaranteed like gross investment in lease payments plus unguaranteed residual value. So if the theory is true, if I discount these payments using the 10%, it should be equal to the 50,000. So when I applied the discount factor for each year, I multiplied the rental with the present with the discount factor and gave me 50,000. So it means the 10% is the implicit rate, which is making all the rental equal to the fair value of the asset. So this is my implicit rate of interest, right? Any confusion in this? Amir Sharif, it is, it would be, I think, in the same scenario. If anyone dies, then we do have to, de-recognize all the lease itself. So we will simply credit the right of use asset and debit the lease liability. Any question on, any confusion on the implicit rate of interest? Okay. So when we say when we talk about the accounting treatment from the lessor's point of view, the first thing being a lessor, what lessor has to do, categorize the underlying lease, whether the lease is the finance lease or the operating lease. Now, this categorization is not required by the lessee. Only the lessor has to do this classification, whether the lease is operating or finance lease. How will we decide whether it is a finance lease or operating lease? Standard says that if it transfers substantially all the risk and rewards of the underlying asset to the lessee, this is a finance lease. Now, there are indicators. For example, the difference between operating and finance lease is that in case of operating lease, asset stays with the lessor and lessor books all the rental received from the lessee as his rental income and depreciate the underlying asset. In case of finance lease, when we say that all the risk and reward substantially transferred to the lessee, now the asset, when the economic benefits are flowing to the lessee, that asset should not be in the books of lessor, it should be in the books of lessee. So that's why standard says that you have to categorize whether the lease is finance lease or operating lease, because in finance lease, asset will be de-recognized and net investment in finance lease will be recognized. I will explain this later. Now, standard says there are few indicators, but this is not a conclusive list, but these indicators are very strong. And the first indicator is if the lease transfers ownership of the underlying asset to the lessee by the end of the lease term. Okay. If we say that you lease this building from me and at the end of the 5 years, the building is yours. So it means the asset is no longer mine. So I have to de-recognize this asset. So this type of lease is a finance lease. The second is the lessee has the option to purchase the underlying asset at the price which is significantly lower than the fair value. Right now, for example, if the end of the lease term, the market value is around 50 million, and I'm giving the lessee option to buy this at 1 million. Now we can say that this is just just a paper talking. Actual asset is still lying with the lessee. So in this case, still lessee has right to get all the economic benefits from the asset. From lessor point of view, this is the finance lease. The next thing is the lease term is for the major part of economic life, not useful life. Standard says it's part of the economic life. So if the lease term is for the major part of economic life, then by nature itself, all the economic benefit will be flowing to the lessee. So there's no point of keeping that asset in the books of the lessor. So this is a finance lease. Fourth indicator is at the inception date, not the commencement date. When you both parties enter into the agreement, you have to the lessor has to assess whether the the lease is finance operating lease. So fourth indicator is present value of all the lease payment, whether that present value equals to the fair value. Now, standard here is using the word two things are very important. The one thing is the inception date, not commencement date, inception date, when the both parties agree into the agreement. Asset may be handed over sometime later, but at the inception date, lessor would assess whether the present value of lease payments, not gross investment in the lease, the lease payment would be discounted, and see if the present value of the lease payment is substantially equal to the fair value. If it is substantially may be judgmental. Some people may say that 80% of the value, some people may say 90%, 85%. I practically saw a scenario where 85% was used as a threshold for substantial. The last thing is the underlying asset is of very specialized nature that only the lessee can use. So if the economic benefits only lessee can obtain from it, lessor cannot use, then there's no point of keeping that asset in the books of the lessor. So it would be finance lease. So about the measurement, standard says at the commencement date. Now again, when lessor has to decide at the inception date, when lessor has to categorize at the inception date, when it would recognize at the commencement date when the asset is actually transferred to the lessee. Now, at the commencement date, lessor shall recognize the asset held under lease in the statement of financial position as a receivable at the amount equal to net investment in finance lease. So when we were doing accounting from the lessee point of view, what we did, we debited the right of use asset and credit what? The lease liability. In this case, it would be vice versa. Now, as this is a finance lease, what lessor would do, lessor would credit the fixed asset, whatever the asset it has leased out to the lessee, and debit the net investment in the finance lease. Right? Now, how we will compute? Let's go back to the basic definitions. What is net investment in finance lease? It is the present value of gross investment discounted at interest rate implicit. What is gross investment? Lease payments plus unguaranteed residual value, right? So in order to compute the net investment finance lease, what we will do, we will continue the same example. In this example, if you see what is my gross investment in the finance lease, what we defined the gross investment as the lease payments plus unguaranteed residual value. So my lease payments are 70,000 and the unguaranteed residual value is this 2,500. So my gross investment in the lease is 72,573. So if I discount these gross investment at the interest rate implicit in the lease, which we calculated as 10%, whatever the present value is, that should be my net investment in finance lease. In this case, it would be 50,000 because we are assuming that the book value and fair value is the same amount. So we will take the discount factor for each year, multiply with the expected amount of the rental, and the resulting amount is adding all these amounts, and it's 50,000. And we have a shortcut for that as well. We will simply take net present value formula. We'll take 10% and yes, 50,000. So what the lessor is doing here, net investment in finance is debit and underlying fixed asset credit at this amount. Now, the amortization table, it runs on the same principles as we saw in case of the lease liability. The same principle, just a minor modification, that in case of lessee, what we used to do finance cost debit and lease liability credit. In this case, what we will be doing, it's NIFL, net investment finance is debit and lease income credit. In the case of lease liability, lease liabilities were debited with the rental and cash and bank. In this case, cash and bank would be debited and net investment would be credited. So, continuing the example, I will delete this. My amortization table would start from 50,000. Opening value for the year one would be 50,000. My finance income would be calculated using the implicit rate of interest, which is 10%. And the lease rental is around 10,000 for each year. I will continue the same example for each year, and then now important thing to note here is that in case of lease, at the end of the lease term, lease liability was 0. But in case of lessor, it would not be 0. It would become equal to the unguaranteed residual value. In case of lessor, the lease schedule will never be equal to 0 because the outstanding amount should be represented by the residual value. Now, let's say if we have a scenario that at the end of the lease term, asset will be returned back to the lessor. Now, when the asset will be returned back to the lessor, at what value should the lessor be recording that asset? Because if it was 0, the resulting value, we cannot, debit the asset with the 0 amount. There has to be certain value. That certain value is the unguaranteed residual value. And that would be offset by whatever the cash amount it would be disposed of against. So looking at the schedule of entries for each year from the lessor point of view, it would be like this. At the inception, net investment finance is debit and fixed asset credit. In each year, you will be booking the finance income against net investment in finance lease, and you will be receiving the rental against the net investment in finance lease. So this is how amortization table would be working for the lessor's accounting, right? If anyone has any question till this point, please let me know. So let's talk about the lease modification from lessor point of view. In case of lessee, it was pretty straightforward that whatever the additional lease component was, you have to treat it as a separate lease if it met the certain criteria. The first rule of modification for the lessor would be the same. For example, if the lease modification gives the lessee additional right to use against additional consideration, that additional part would be considered as a separate lease component, and a separate accounting treatment would be triggered. Separate net investment and finance lease would be recorded. But if this is not the case, then here's the tricky part. If this is not the case, then the lessee has to assess that with the modification, had this modification done at the inception date, would this lease be classified as operating lease, or it would remain the finance lease? The lessor has to evaluate from this perspective. For example, if this modification was known to the lessor at the beginning, and considering that modification, if that modification resulted in the operating lease, then the lessor has to count the lease as the new lease and extinguish the existing one, right? And if this is not the case, like, if lessor assessed that if the modification was known to him at inception, and with that modification, the niche classification of the lease is not changing, then standard says that this modification would be dealt under the IFRS 9. Now, IFRS 9 is the standard for the financial instruments, right? Now, IFRS standard says that the remeasurement of this kind of modification, the standard says there's a rule for 10% rule. Now, standard says that in this case of scenario, what you should do, you should discount the revised cash flow using the revised implicit rate of interest and see if the change is substantial or not substantial. If the change is substantial, the substantial standard says it's around 10%. So if the change is more than 10%, then the lessor has to extinguish its current net investment in finance lease and record a new one. So if the change is not substantial, then whatever the difference is, straightforward charge it to the profit and loss account. So I guess that's it. That's pretty much it. That's pretty much it for the lessor accounting and lessee accounting. Again, we only discussed very simple concept, very fundamental for the lease accounting. The thing we have not covered in today's session is the sale and leaseback. Now, this is a second major change which IFRS 16 did. In the previous standard, the accounting for the sale and leaseback was pretty simple and it was not very complicated. But in the IFRS 16, it is pretty much complicated. And the second thing is manufacturer dealer lessor. We have not included this into this session because of time constraint. The next thing is adoption of the IFRS 16. For the first time, the company which is converting from the IFRS SMEs to the full IFRS, how they should deal with the adoption of IFRS 16. It is again another topic and require another 1 hour session. The next thing is sublease complication, which are not covered in today's session, right? So anyone has any question till this till the points we already discussed, I would happy to answer them. Over to you, Suman. Yes, Kusala, operating lease is still in use, but like I said, only the lessor has to assess whether the lease is operating lease or finance lease. So yes, the operating lease is still pretty much active in the industry. So lessor still recognize the lease income on the accrual basis for the leases which are falling under the purview of operating leases.